This is Nightly Business Report with Tyler Matheson and Sue Herrera.
More hikes ahead. A strengthening economy puts the Fed on track to raise interest rates, but the market reaction left some investors confused. Curb appeal. Home sales post their sharpest drop in 3 years as ownership becomes less and less affordable. Plus, mountains of debt. Why the White House is now considering action on student loans, a $1.5 trillion issue. Those stories and more tonight on Nightly Business Report for Wednesday, February 21st. Good evening, everyone, and welcome. Glad you could join us. Sue Herrera has the evening off. Well, the economy is improving. Growth is picking up, inflation ticking higher. That's how Federal Reserve policymakers describe the economy according to the minutes of the central bank's latest meeting. That signaled that the Fed is on track now to raise interest rates this year. Markets greeted the news with a strong bout of volatility. Stocks first spiked higher, and then they fell very sharply as bond yields rose. The Dow Jones Industrial Average closed down 167 points to 24,797, its second straight day of losses. NASDAQ was off 16. The S&P 500 fell 15. Kayla Tausche starts us off tonight with a closer look at the central bank's latest plan to keep raising rates.
The Federal Reserve's January meeting was the first since tax reform passed. That's one big reason the Fed pointed to a stronger growth outlook than before. Business may use the money to grow and add capacity, even though companies are still deciding how to allocate their savings. While the Fed warned of upside risks from that growth, Kevin Hassett, the White House chief economist, doesn't expect the economy to overheat.
What we have here is a supply side stimulus, which is going to increase supply and I think allow us to grow without getting inflation out of control.
The Federal Reserve plans to raise interest rates gradually this year and next and says for now that strategy remains appropriate. The market's treating the minutes from this Fed meeting, the first of 8 this year, as tea leaves for the new Fed's direction. And investors will get more information next week. Newly installed Fed Chair Jay Powell will be testifying in front of Congress twice.
I think Jay Powell will have to establish his credentials as a new Fed chair, and I think part of that is going to be to say something pretty negative about the amount of fiscal expansion here and express some worries about the rise in the federal budget deficit.
The January meeting took place before a bipartisan budget deal expanded spending and before a January jobs report with wage growth so strong it spooked the market, spurring a sharp drop in stocks. Days earlier, Fed members found signs of broad wage growth to be absent, leading the Fed to keep its wait-and-see approach to inflation intact.
I think inflation is rising gradually. A lower dollar and higher oil prices this year are pushing inflation up a bit. There's a little bit of wage inflation. But overall, the modern American economy just isn't that prone to basic consumer inflation. What I think the Federal Reserve is becoming more worried about, and you can actually see this in the minutes, is asset prices.
One worry raised by more Fed members in January: imbalances in the market thanks to high valuations and high levels of corporate debt. For Nightly Business Report, I'm Kayla Tausche in Washington.
So why was the stock market reaction to the minutes from the Federal Reserve meeting so intense and so all over the place? Bob Bazzani takes a look from the New York Stock Exchange.
Talk about a confusing day. Stocks were modestly higher all day until the minutes from the Federal Reserve's January 31st meeting came out at 2 p.m. Eastern Time. So traders liked what they heard. The Fed said there were very few signs of a broad-based increase in wage growth. Traders have been worried that inflation is picking up and that higher rates would kill the rally. So the Fed saying, we're not too worried, was greeted as a positive sign. And bond yields initially dropped. But then it all turned around. Bond yields moved back up from about 2.91% on the 10-year to 2.95%. And predictably, the market just turned around. Everything went down. What happened? So it was widely noted right after the Fed minutes came out that this meeting occurred before the January jobs and wage report came out, which both were stronger than expected. And the meeting also occurred before President Trump signed a new budget that contains a significant increase in deficit spending. The bottom line is this: after thinking about it, most traders seem to agree that if the Fed held the meeting today with all the information that's come out since, the Fed would sound more aggressive when it comes to hiking interest rates than it did in the January 31st meeting. That's how fast all of this is changing. I know it's confusing. For Nightly Business Report, I'm Bob Bazzani at the New York Stock Exchange.
Well, the central bank is widely expected to raise interest rates next month, the first of what many market watchers say could be 3 rate hikes this year, maybe even more. But the president of the Philadelphia Fed said today that he thinks just 2 interest rate increases will be appropriate this year. Patrick Harper did say, however, that he would be open to additional hikes if the economy shows that more are needed. That's called an open mind. All right, let's now turn our attention to those January Fed minutes that were released today. And joining us to offer his thoughts on the economic outlook and more is Mark Zandi, chief economist at Moody's Analytics. Mark, always great to see you. Thank you for joining us. What did you make of these minutes that the market at first sort of saw benignly and then saw seemingly in a different way?
Yeah, well, I think the Fed was just more sure about things, or more sure about the economic growth that's coming. We're going to see strong above potential growth, falling unemployment. And they were more sure about inflation, that we're going to get back to that 2% inflation target. So more growth, more inflation, I think, that makes investors a little bit nervous about higher interest rates, higher bond yields, and of course, that gives stock investors agita. So I just think the Fed was just more sure.
If they had had this meeting, let's play a game of hypotheticals here, with the benefit of knowing what that jobs report was going to be in February, what the budget deal was going to be, would they have been even more optimistic about growth and hence more hawkish?
Yeah, absolutely. I mean, particularly the budget deal. I mean, one economic data point, no big deal. You need a string of economic data.
Right.
But the budget deal, the spending, I mean, that was all deficit finance. That's going to add, additional half a point to growth this year and another half a point next year, on top of an economy that's already growing above potential, with an unemployment rate that's headed into the 3s. So, yeah, I think if the Fed were sitting down today, they would be even more hawkish than what came through in those January.
I'm going to ask the great Zandi to give me his numbers. What do you put your turban on and tell me, what do you see for growth this year? What do you see for inflation, unemployment? What are your benchmarks here?
Yeah, I think we're going to be close to 3% growth. That means that unemployment will decline. So the unemployment rate is just over 4. By this time next year, it's going to be closing in on 3. That means inflation is going to accelerate. That means the Fed's really got to get moving here. I think, they say 3 rate hikes, 25 basis points, a quarter point each time. More likely it's going to be 4, and then probably 4 next year. So I think investors, they're adjusting to this new reality. I think they have more adjusting to do.
The trick is not merely in the current environment, Mark, is it what the Fed does with interest rates, but what they do with the roll-off of securities from their balance sheet. And that side of tightening plays a role here, too.
Yeah, good point. I mean, I think that's kind of on autopilot. They told us what they're going to do, and I think they're going to stick to that script. But that does add to the prospects for higher long-term interest rates because, up until a year ago, 2 years ago, the Fed was buying bonds. Now they're letting those bonds roll off, as you say. They're not buying bonds. And you throw into the mix the fact that the government, the Treasury, is going to be issuing lots of bonds to pay for all these deficit finance tax cuts and spending increases. So demand, supply means higher long-term interest rates. So we saw the 10-year Treasury yield hit a new 4-year high today. It's probably going to go higher, and of course that makes life more difficult for stock investors.
Mark, it's always great to see you. Thank you. Mark Zandi with Moody's. All righty, housing is a critical part of the economy, as we all know, and what we've just been talking about certainly plays a role in that. And today, 2 new reports out showing a spring slowdown at the very busiest time of the year for real estate. Diana Olick has more.
There's, I think, about 500 homes.
Demand for housing is very hot.
So it's 3 bedrooms, right?
Actual home sales are not. January sales of existing homes dropped more than expected for the month and were down a surprising 5% compared to a year ago, the biggest annual drop in 3 years. The problem? Another big drop in supply, down nearly 10% compared to last year, and affordable supply is even lower. Sales are dropping all on the lower end of the market, steepest for homes priced under $100,000 and still down between $100,000 and $250,000. Sales are actually gaining on the higher end, but more than half of the market exists on the low end. That's a problem. Even more so because these numbers represent January closings. That is, deals made before mortgage rates started to rise.
The mortgage rates are rising for good reasons of economic expansion, strong job growth, wages beginning to rise. But anytime mortgage rate rise, it holds back some buyers on the margin.
Rates are now up more than 0.5 percentage point since the beginning of this year. Last week, mortgage applications to buy a home fell for the second straight week and are barely higher than a year ago. That means home sales could be lower in the next few months as well. The realtors are begging for new construction, but builders are not that active on the low end because of sky-high construction costs. The realtors are also now making a plea to investors who bought all those foreclosed homes during the recession, asking them to sell.
The price appreciation has been very good, but the future rent growth may not be as bright as what it had been. So if the investors begin to unload, there will be a welcoming trend for the housing market currently as we need more inventory.
That, however, is unlikely. Rents and rental occupancy are both strong, and investors have spent millions of dollars not just on homes, but on renovations and new management infrastructure. There's no compelling reason, other than generosity to the rest of the housing market, for them to get out now. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about the fall in existing home sales and housing affordability, head to our website, you know it, nbr.com. Well, the Supreme Court today limited protections for corporate whistleblowers. The ruling states that whistleblowers are not shielded from being fired under a federal law unless they have reported the potential wrongdoing to the Securities and Exchange Commission. The decision narrows the SEC's interpretation of the 2010 financial overhaul known as Dodd-Frank. The ruling was unanimous. All right, time now for some upgrades and downgrades in the market session today. Regeneron downgraded to hold from buy at Canaccord. The firm cites Regeneron's decision to no longer provide guidance for its macular degeneration treatment and increased competition for an eczema drug. The price target lowered to $356. Shares fell nearly 2% to $317.51. Match Group's rating was downgraded to neutral from overweight at J.P. Morgan. The firm calls the stock fairly valued, sees few catalysts ahead. And the price target is unchanged at $42 a share. Shares fell fractionally to just under $42 a share. Palo Alto Networks upgraded to positive from neutral at Susquehanna. The firm expects Palo Alto to report solid quarterlies later this month. The price target lifted there to $195 a share. The stock rose about 1% to $164.40. And still ahead, would breaking up big tech be good for shareholders? China is set to overtake the U.S. as the biggest nuclear energy nation. A new report puts China on track to more than triple its nuclear energy capacity over the next 20 years. Now, China's push into nuclear power comes as that country puts an emphasis on clean energy. The U.S. has been the global leader in nuclear power since the 1960s. Well, Dish Network reports disappointing revenue, and that is where we begin tonight's market focus. The satellite TV provider added more subscribers in its online streaming service, but wasn't enough to offset declines in the company's core satellite business. Profits improved largely because of a $1 billion benefit tied to that new tax law. The stock off 3% at $43.18. Advance Auto Parts reported better than expected quarterlies, though revenue did slide. The company said it is working to grow its market share and improve margins. That was enough for investors. They sent the stock up 8% to 114 on the nose. And the electric utility Southern Company reported better than expected earnings despite a drop in customer usage. The company said it plans to pass along savings from the new tax law to its customers.
We did benefit from a lower tax rate. The net effect of that, now I'm speaking very broadly, every company's going to be a wee bit different, but we will be able to reduce rates, we believe, in about the 5 to 7% range and do the things necessary to restore our financial integrity, our credit metrics.
Southern Company shares fell 1% to $42.92. And an activist investor is urging Bloomin' Brands to make changes that it says could double the restaurant operator's stock price. The hedge fund Barrington Capital wants Bloomin' to spin off its smaller brands into one company and run Outback Steakhouse as a standalone business. Shares of Bloomin' rose 5% to $22.02. Meantime, Broadcom cut its offer to buy Qualcomm following Qualcomm's move to raise its bid for NXP Semiconductors. Broadcom's revised $79 a share offer, down from $82, was met with disdain. Qualcomm said the new proposal made an inadequate offer even worse. So there. A potential merger between Qualcomm and Broadcom would represent the largest technology acquisition to date. Broadcom shares off fractionally, $248.62. Qualcomm down nearly 1%, $63.40. And after the bell, the streaming service Roku issued disappointing revenue guidance. That offset a surprise profit in the most recent quarter. Shares initially plunged in the after-hours market, but finished the regular day down a tick to $51.10. Amazon has launched a line of consumer health products challenging pharmacy retail chains. The products are produced by private label manufacturer Perrigo and include items ranging from ibuprofen to hair regrowth treatments. The move by Amazon could spark a price war and pressure drugstore profit margins. That is why you see drugstore stocks lower today. And today, Amazon shares hit $1,500 for the first time ever. They closed just below that level. Well, there's a growing conversation now over big tech's dominance and whether industry titans have gotten just too big. In a New York Times Magazine article called "The Case Against Google," critics say the search giant is squelching competition before it begins. So, should the government step in? The author is one of the country's leading business journalists, Charles Duhigg. He highlights how easy it is for Google to weaken another business. Mr. Duhigg is a Pulitzer Prize-winning writer for the New York Times. Charles, welcome. Good to have you back.
Thanks for having me.
What is the main gripe that companies have against Google, and why do they say that it is illegal, not just unfair, but illegal what they're doing?
Well, what companies say is that Google has become so big that it's essentially a gatekeeper, right? Google is the front door to the internet at this point. And so if Google makes decisions that mean that your website won't show up, and some of Google's decisions have negatively impacted whole categories of websites, such as competing search engines that might look at a specific type of product, like airline tickets or finding good deals online. If Google decides that that kind of website shouldn't be prioritized, if it doesn't show up on the first or second or third or fourth page of Google, then they essentially become invisible, impossible for anyone to find. And in fact, European authorities have agreed. Last year, the European Commission ruled that Google was using its monopoly might, its dominant power, in illegal ways, and fined the company over $2 billion and ordered them to change.
What did your personal research show? What do you find when you go in and use Google? Do you get suspicious that they're burying things, or what?
Well, it's definitely true that there's some types of things that you search for now where the results that come up from Google are not necessarily always in the user's best interest, right? The Federal Trade Commission has found this in the United States. European authorities have found this. And oftentimes what happens now at the top of a Google page is that it gives you results that are essentially ads. It's not completely clear, I think, to the common user that it's an ad. It'll say sponsored in a little corner on the box at the top of the Google page. But what users should understand is that companies are buying the right to appear on that page. It's not necessarily the lowest price that you're going to find for a particular product. It's a company that has paid for the ability to be at the top of that page. That's also true of Amazon and basically every other large website at this point.
I've certainly seen that in my experience, that when I go and look for a hotel, often the first 2 or 3 are sponsored content, and then I get down into the lower ones. Let's talk about its dominance in search, because that's where it really is the dominant player. But there are other search engines. There's Bing, there's Yahoo, and there are other players, as you say, that are more niche-y. how have they been disadvantaged, or is Google just the brand name here and better?
Well, it's a great question, right? Because this is the argument that many of Google's defenders, as well as the company itself, makes, which is there are alternatives. One you didn't mention is DuckDuckGo, which is a website that promises not to look at any of your information as you use it to search. The thing I would ask anyone watching this is, when's the last time you went to Bing or DuckDuckGo in order to conduct a search? We basically don't, right? And this is a characteristic of the internet economy. There's a winner-take-all effect where Google has become dominant because it's a great search engine. But then that raises this question, does that mean because it's a great search engine that it should live by certain special rules? Rules that don't apply to anyone else, but that give everyone a fair chance when they go online?
Well, it's a wonderful and a very complete article. If you get a chance to read it over the weekend, I certainly recommend it. Charles Duhigg's work is always terrific. Thank you very much.
Thanks for having me.
You bet. Coming up, why the White House is taking a new look at a $1.5 trillion issue. AT&T has named the first cities that will get its fifth-generation wireless broadband. 5G will be rolled out initially in Atlanta, Dallas, and Waco, Texas, with plans to install it in 12 cities by the end of the year. 5G expected to be more reliable and offer internet speeds 10 to 100 times faster than current 4G broadband technology. And a new survey shows that Americans are planning to use their tax refunds this year either to pay down credit card debt or to add to their savings. That's different than in past years, when most of them said they typically go out and spend the money they get back from the government. Last year, the IRS issued nearly 112 million refunds, averaging about $2,900 apiece. Well, the Trump administration is proposing new types of health care plans, ones that would not meet some of the Affordable Care Act standards. The Department of Health and Human Services said alternative plans would help lower premiums. Critics cautioned, though, that these plans would be less comprehensive and could deny coverage based on pre-existing conditions. It could also draw healthy people away from the Affordable Care Act's insurance markets. The Trump administration has also signaled that it is open to a kind of mileage tax. The White House today praised an experimental program in Oregon as a way to find new revenue sources to help pay for the proposed infrastructure program. In Oregon, volunteering motorists are charged a fee of 1.7 cents for each mile they drive on state roads. In return, drivers get rebates for state fuel taxes. As of the end of 2016, only 700 people were participating in the program. And meantime, the White House is looking at a way to help student loan borrowers get out from mountains of debt, but it does come with a catch. As Scott Cohn reports from San Jose, the proposal would make it easier for borrowers to erase their student debts through bankruptcy.
Step onto almost any college campus, like San Jose State here in California, and it's hard to find a student who isn't here, at least in part, on borrowed money.
Yes, I have a lot of student loans.
I'm kind of looking at 20,000 for all 2 years that I'm hoping to pay off eventually.
Student loan debt has gone no place but up, now approaching $1.5 trillion, more than doubling in just the last decade. And along with it, the level of defaults. 8.5 million borrowers in default, or more than 1 in 10 student loans. But beyond that, an entire generation of students like Jennifer Lee facing crushing debt just as they enter the economy.
You know, you want to come out on a fresh start, but you're actually holding all this weight of money that you've you feel like you've worked so hard for.
One of the things that makes student loan debt such a drag on the economy is that it's so hard to get rid of. The interest rate is higher than on most other loans, and a 40-year-old federal law makes it next to impossible to get relief even by declaring bankruptcy. Activists have long been calling for a change in the law, and now the Trump administration is seeking public comment on at least changing the way it's enforced. An attorney who works with troubled borrowers says it's a start, but not enough.
We're seeing the programs that can provide the most benefits to borrowers, like defense to repayment, like income-driven repayment, public service loan forgiveness. We're seeing those programs targeted for elimination.
The administration has taken aim at student aid in its proposed budget, slashing Pell Grants for low-income students, ending federal work-study programs, and ending an Obama-era crackdown on student loan servicers. Easing the bankruptcy restriction risks leaving more students with a stain on their finances just as they start their careers. And there's another risk. The more debt is wiped out, the greater the cost to the taxpayers, which is why the bankruptcy rules were put in place to begin with. For Nightly Business Report, I'm Scott Cohn in San Jose, California.
All right, before we go, let's take another look at the day on Wall Street. The Dow yo-yoed much of the day, finished down 167 at 24,797. Second straight day of losses there. NASDAQ off 16, and the S&P 500 fell 15. Well, that'll do it for Nightly Business Report for tonight. I'm Tyler Matheson. Thanks so much for being here. Have a great evening, everybody, and we hope to see you right back here tomorrow night.